Good afternoon, ladies and gentlemen. This is Phil Pearlman. I am joined today by Chris Kimble Charting Solutions. How are you, sir?
Great, Phil. How are you, Doc?
I'm fantastic. Let me just say before we get going here, you look marvelous. You look great, dude. Fantastic.
And we're trying to tell people the truth here, Phil. I wouldn't go there so early in the interview.
Dude, I know it. I know you're down 70 from your all-time high. You're in a bear market, and you look great, dude. And you're getting out there. You're doing it. I'm just pumped for you, man.
Well, I'm not quite the charter member of the Swine Club as I was in the past.
No. You look, dude. You're doing great. You look younger. You look 10 years younger.
Back at you, buddy.
Right on. All right, let's do this. Today we're going to talk about bonds. Huge inflection point. By the way, Kimble is a master chartist, been around the block about 100 times. He's seen it all. We are in lunacy. We all know it. You know, the markets and the world really have these periods, extended periods of stability, interspersed with briefer times of complete chaos, world on tilt. We are right now smack dab into in one of those periods. And we're blessed and lucky to have Chris on here. We're going to try not to get too wide. We're going to try to keep this talk very narrow. But before we begin, I do want to just ask you broadly, how about this environment?
Pretty crazy, Phil. This past month, I celebrated my 40th anniversary in the business, and I hope that going through the 87 crash, the rally in the 90s, and the 2003 decline, and that is helping sharpen my knife for a little bit of what we're doing now. But as we know, and even if you lived 100 years, we're experiencing some things, of late that hardly anybody that can fog a mirror has seen.
And we get through them. Right? I mean, so this too shall pass. Is that correct?
Absolutely.
Okay. That huge thing right off the bat. You've been through it, 87, 2000, 2008. Now we will get through this as well. And it's great to hear it from you, somebody with the, with the experience under your belt. Okay. So let's get into this because I don't want to spend too much time on anything else because we have a lot to talk about here in relation to Treasuries. We could talk about oil. We could talk about the stock market. There's 100 things we could talk about, but you have a great take here. We are at an inflection point. How long has the bull market in Treasuries lasted?
Well, essentially, since Paul Volcker, Doc, in the early 80s when T-bills, I think at one point in time had either 21% and was born into a time that my first mortgage was 12.5% fixed in 1983. So it was an ugly scenario. But essentially, since then, what have we seen for almost 4 decades? Lower highs and lower lows. And if we flip that around, and that'll be the first chart that we look at, Doc, is that since we've just seen a series from bond prices of higher lows and higher highs just consistently for the last few decades. And as we talked last week, just in a personal phone call, the death of the bond market has been, over exaggerated. I remember when Ridex came out with the inverse mutual fund in the early 2000s, thinking, hey, we created this tool, interest rates, it's over, they're going up, and been on the wrong side. And that's why I think you'll feel recognizing a trend. You could either be a trend fighter or a follower. Discussion is about is potentially, we're at an inflection point that, is this where it finally changes? So we'll discuss some of those things today.
So 40-year bull market in bonds, bear market in yields, the inverse of the price. And rates have just been coming down forever. And we reached a point very recently. And by the way, the roadsides are strewn with people calling a top in the bond market and a bottom in yields. That's been going on for years. However, and you're not saying this is 100%, but you're saying there's reason to believe, utilizing the analysis of price behavior, that we have seen or are seeing right now a blow off top in the bond market in treasuries. Chart 1, this is a chart that you've brought to us, is inverted yields. This is a long-term chart. Why don't you tell us about this chart 1?
Yeah, Phil, as we all know, we got a teeter-totter between yields and bond prices. And so what I did was I just took the 30-year yield chart and inverted it so that it would look like bond prices for all of us. So we could just kind of replicate the bond rally. And as you'll see on this chart, we've just seen a series of higher lows and higher lows and higher lows and higher highs, for decades. And I think, the one thing before we get into a couple of nitty-gritties, Phil, is, that I believe when it comes to my work or, people in the technical world is that weekly charts, Phil, are more important than daily charts. And then when it comes to what's more important to that, monthly charts are more important than weekly. And I feel for a lot of people around the world, Phil, that they didn't see the monster bearish reversal pattern in the S&P 500 in January. And it was what we kind of want to call a doji star gravestone bearish reversal pattern. And we're down, 30% since then. And so I just say that as a preface to the pattern that we're looking at now. So this pattern that we're looking at in the potential, as we discussed last week, the month isn't over with yet. But so far, 8 days towards the end of the month, yields are making the largest bearish reversal pattern in the last 40 years in yields. And they are making the reversal pattern in the S&P, Phil, that took place in January look like the shortest of the 7 dwarfs.
Okay, so let me make sure I have this and I understand this. You are a chartist, a technician, a master technician, but you're also a top-down guy. You're a big picture guy. So it's like best of both worlds. And so you are taking a very long-term view of what's happening here. Instead of looking at daily candles or even weekly candles, you're looking at monthly candles. This is a 27-year chart. And you're looking at the monthly candles, and you're getting a little bit ahead of yourself because there are still 7 or 8 days left in the month, 4 or 5 trading days left. And however, you're sort of anticipating what this March monthly candle is going to look like. And it looks like a huge blow off top to you. Am I getting that right?
I don't know that need to say much further, Phil. It's just that this potential reversal pattern is taking place. If you just start connecting the dots, you just take these series of higher highs for the last few decades, you extend the line out in the future. I mean, you could have made this line 7 or 8 years ago, and all of a sudden this month, it rallies up to that line. And for, I think, a matter of 3 days, Phil, I mean, it pushed through that line like the mother of all bullish breakouts was taking place. And then not last Wednesday, but the Wednesday before last, that's when some chaos started taking place in the bond market. And from the 10-year yield perspective, Phil, it had fallen 50% in 5 days. Next 5 days, it rallied 50% in 5 days. It's that combination, Phil, of a 50% decline and a 15% rally that's so far this month creating this giant reversal pattern at a 27-year resistance level.
And so you imagine we are now sort of changing regimes, really, and heading into an environment in which interest rates will begin rising.
Potential is there. The old adage, one day doesn't make a trend, 1 week doesn't make a trend. Does one giant reversal make a trend? But no, you better not be an ostrich and stick your head in the sand and say that it can't happen, And so we're close to zero. And it's just amazing, Phil, where all of this is taking place. And, I think the world knows by now that there's some unrest in the credit markets. And that unrest is, to me, really important because, in my opinion, this is a fact. The bond market is just tons bigger than the stock market. And so from analogy, I think the bond market is the dog and the stock market is the tail. And all of a sudden, the dog is getting its own little virus. It's feeling a little sick. And then parts of the tail have been falling off of late. And so to me, the black swan is not how the stock market's doing, is that our government's got to keep the system healthy as possible. And I believe that is all we we woke up this morning to just more government intervention to try to keep the dog healthy.
Gotcha. Okay, so it's sobering. Now, let me ask you this: what is the relationship potentially here between this regime change in treasuries and stocks, or is that not that can we not answer that yet?
No, there's, if we look at, holding up two hands, on one hand, I think we'd like to see interest rates actually rise, Phil, due to good news, some good economic strength. That would be, that's probably a prayer to wish for people all over the planet. I don't care what, country you're from, is can we get some good news out of things? The other hand, is that we won't know for a long time. It's not about the why, but, this business, as you know, Phil, is funny, is, you really don't know the reason things took place till long after an actionable pattern took place, and so could rates be going up because of something negative? In our next chart, we're going to see that rates are actually skyrocketing in certain bond sectors and ETFs, that's not happening so far to that degree in the government paper market, but we would.
So this is the 4-pack. This is chart 2. The 4-pack, and tell me what is going on here. What do you got here?
Phil, and there's like you said, the 4-pack, and the upper left is AGG, which is a popular ETF that's kind of a blend of different types of bonds. In the upper right is junk. Junk bonds don't have to be explained a lot. The lower left is investment grade bonds, and in the lower right is munis. And I got a little picture of Buzz Lightyear that says "to infinity and beyond" on here, and that's what we're seeing since the Wednesday before last. So in the past 8 business days, Phil, these charts are inverted, everybody, so that we could look at what yields are acting like. And so in other words, these bonds are falling off the table, of late. And so today's call is not about why people are selling the heck out of muni bonds and why people are selling investment grade. It's just happening, everybody, and so, I think, thank goodness, one thing is that government yields have settled down, Phil, over the last week, and they're not acting quite as poorly as what we're seeing in this 4-pack. But could the bond bull market in these 4 be over? That's still not determined, but this is not what the government wants to see when they're trying to drive rates to zero, and these things are turning into hockey sticks to the upside.
So there's somebody bigger than the government, and it's just the market.
It is, when, you could say don't fight the Fed, but, has there ever been a time in my 40 years that the Feds followed the free market? That's happened more than I can count on a couple of hands. So.
Right. Well, it's sobering. And the other thing that I just wanted to point out from what you're saying is that we're not talking about why here. There's jokes about economists, two points of view, all you need is one economist, or however that joke goes. But we're not talking about what these, all of these complex macro currents are, and there's 100 currents going on simultaneously, and we couldn't analyze all of them. All we're talking about really is the proof in the pudding, which is price behavior, and what we're seeing out of price behavior and the assumptions that we can and cannot make there, and the way that we can use price behavior to manage risk. So that's a question. Before we move on to the last slide, here's a question that I have for you, and that is, how can we take what we're seeing here over the next, and through the end of the month, into the beginning of April, and even beyond that? Are there anything that, are there things that we can do, boots on the ground, to manage risk utilizing the patterns that you are pointing out to us here?
To me, there is, Phil. We do want to see, as you've mentioned a couple of times, how does the end of the month turn out? And so far, let's say that nothing changed, Phil, between today being March the 23rd and March, the 31st. If yields stay exactly where they are, you're still going to have a monster reversal pattern, And if you wiped out and just looked at monthly closing, it will have closed up against a 27-year resistance line with, when you look at momentum, Phil, the highest ever. And so that, do you call the death of the bond market? No, but, when we talk about the whys, I remember when I would express concerns to my mentor and friend, Sir John Templeton, he'd always ask me this question, Chris, do you know a secret that the rest of the world doesn't know? And I would always have to say, no, I don't. And he goes, so you got to just take the price action for what it is, because that's all the knowledge that everybody on the planet knows in that given day. And that's why I just say, if you didn't know what chart this was, if I sent it or looked at it and you hid the name, you would in your heart say, wow, that is one heck of a turnaround. And I don't know why it's happening, but it's sure doing that at a resistance line that I think we better pay attention to. And that's why I'm humbled to be here, just to make people aware. It's going to be really interesting, like you said, Phil, 30, 60, 90, a year from now, where are we going to be at this after following this critical pattern?
Okay, so let's take a look at the third chart that you have here. What do you have going on here?
Well, every Friday I put out a piece called Joe Friday, from the Dragnet Show, Just the Facts, Man. And I think this is a critical piece, and we're now leaving the avenue of yields, and we're going and looking at a couple of other instruments. Phil, since December of 2018, yield's been heading south, copper's been heading south, and so has crude oil. And so when we think of the game show to tell the truth, stocks haven't been telling the truth, and these economic sensitive indexes or indices, sectors, they've been heading south, reflecting weakness, saying, pay attention to me. And people have overlooked them, but they've been heading south, Phil, 14 months prior to the coronavirus being known. And so to me, there's a key message. Stocks are testing the 2018 December lows. Copper is testing a support line that goes back 15 years. And crude oil is testing a 10-year support line all at the same time. So I think the prayers on this Monday, when we hope that there's some type of a positive bill that comes out of the Congress or the Senate that gives us some form of actionable ideas and relief. But to me, if you hid these names, if all three of these would break at the same time, now we have new support breaks that are probably going to activate even more sell programs than we've seen so far. So this is a place where realistically, you want to see these key assets hanging into where they are right now.
So if I understand you correctly from the total of this conversation, we would love to believe that maybe rates have bottomed and are now beginning to head up from very low levels because the economy is picking up and there is some reinflation. However, if we look at the weight of the evidence, if we look at not only the first chart you showed us of the yields of the 30-year monthly candles turned upside down, inverted, but if we also look at copper, if we also look at oil, then that reinflation argument is much more difficult to make. And as a matter of fact, that the levels that we're at right now, not only in treasuries, not only in stocks, but in these commodities are also super, super critical in terms of support and where we may be headed.
That's correct, Phil. And like you say, if copper and crude oil keep heading south, it's, how do you make an argument that yields are going up due to strength? It just seems like a true outlier, right? That's a Six Sigma, thought process. But I want to just kind of, my company name, I kid people, is not Kimble Charting Problems. It's Kimble Charting Solutions. And when I got started 40 years ago, the toolbox was really small that all of us could take advantage of. But when you open that toolbox today, it is massive. And no matter how this world unfolds, this giant experiment that we're unwilling participants in, there's some tool that's going to do really well. The old adage, there's a bull market somewhere, that couldn't be true. So if for some reason that yields are peaking, Phil, due to a concern about us as a country, there are still ETFs to make money if interest rates rise. Just simply, it's not about why, but if rates rise, TBF would do well and TBT should do well, in time. So those would be tools for people to be aware of, that for some reason, if the bull is sick as far as the bond market, there's good plays on the flip side without involving futures.
Those are inverted bond price ETFs. Is that correct?
Yeah,
So
if you can imagine,
TBT, if the long end goes down, TBT goes up. Is that correct?
Well, if yields start to rally, they start to rally. So you can only imagine what a terrible tool that they've been. They've been the worst thing to own for 30 years, right? Well, if this reversal happens to be the case, if we look back years from now, wow, it wasn't about Kimble. The world created that reversal plan or that reversal pattern. If it is a true reversal and an ending of that, TBT and TBF that have really stunk it up for decades will probably have a decent run at it.
Okay, so I want to come back to a question that I asked you earlier on. I asked you, this will pass, right? And I'm talking about, I'm talking a little bit more about stocks here, but I hear you. TBT, no, actually, before I ask that, on TBT, that's an inverted index. That's an inverted ETF. Can you perform price behavior analysis, technical analysis on that? Or do you use TLT and then just use TBT as a trading, if TLT is negative or bearish, then you go TBT, or do you do technical analysis on TBT directly?
Well, beautiful question, Phil. And I'm not a fan of charting the 2X, to make a lot of decisions. So the two key charts, I love this question, Phil, would be just what you said, would be TLT, and then TBF is a 1X. So, it doesn't correlate 100% with TBF, with TLT, excuse me. But watching the chart pattern on TBF is essential if you believe that, this could be a reversal in yields. Okay. So yes, you want a chart, but I try to leave it. I try to leave the double X out of there almost in all scenarios if you've got any lengthier perspective.
Last question. Earlier in our conversation, I asked you about, will this pass? The shorter periods of chaos followed by more extended periods of relative calm. I mean, the world's never totally sane, but relative calm. What are you looking for that will give you some clue that we're heading out of the chaos?
Well, sentiment is obviously at an extreme and a heck of a flip switch,
right?
A flip of the switch, Phil, from dumb money was very cocky the first of the year, and it's now scared to death. Smart money was running for the hills first of the year, and now it's changed. One of the things that I find the most fascinating, Phil, is to look at, lift up the hood and look at the RIDEX funds cash level to stock value. And it's something that helped me in picking the 2011 bottom, and we'll get on a different day, Phil, but here's the thing I'm shocked about is despite this hammering in the market, total assets in the RIDEX money market fund or overall money market funds, shockingly to me, is not exploding to the upside.
So you're looking at people going to cash as a capitulation. And in the data that you're looking at on the RIDEX money market, you're not seeing that yet.
Perfect, Phil, because guess how easy it is to fill out a survey? Yeah, I'm bullish, or how I'm bearish. That is different than moving your money. And so one is a survey, one's actionable. And so far, I personally am surprised we are not seeing just floods of money go into these public surveys of these money market values. And so the 2011 low, as an example, Phil, was $1.50 in the money market fund in RIDEX for every buck that was in stock funds. It was like people had a fuel tank and they put an extra fuel tank on the car. The fuel was there just to propel things way higher. So right now that ratio, Phil, is like 0.2. And it's just nowhere close to the 1.5.
Wow.
So that's, so outside of sentiment, I'd really like to see people taking action versus just a survey.
Hey, listen, we're out of time. Wow, that's like a whole nother call, a whole nother conversation. What the can of worms you just opened, but we're running out of time, and I just want to thank you, Chris. I mean, you're my boy, old school, and I love you. It's so great to see you, and it's so great to see you looking fantastic. I can't get over it. I'm loving it. But thank you so much for coming here. This is exactly what I wanted to talk about: shedding light on the bond market, opening up a whole other can of worms. Maybe we just do this again in a couple of weeks and talk about Ridex.
I'd love to, Phil. And as you know, we're all blessed by, we're all a hodgepodge of people that have influenced our lives and that we've been able to meet. And buddy, I wouldn't be here without you. I love you. You have done so many wonderful things for the world, and long from now, how they always talk about the most important thing on a tombstone is not the beginning and the end, the dash. You got a big dash, buddy. Love you.
Dude.
Take care.
Adios.
See ya. Thank you.